Let's talk to Tim Gregory. He is an investment manager at Vermeer Investment Management. Morning to you, Tim.
Morning, Nick.
Okay, let's kick off. You came on the show earlier in the year. You said S&P 2872. We wouldn't take out that old high for the rest of the year. And guess what? We did. Not the same picture in Europe in terms of the FTSE. We're back in a trading range. What are you thinking in terms of the US markets? Obviously, we've got this aggravation in terms of the US interest rate cycle. Yeah. Let's kick off with that.
Yeah, I mean, that's absolutely right. Hands up. I said I thought, in late January when we peaked on that big spike, 2872, that it would be a real struggle for markets to get above that. I guess it took, my defence is it took 6 months, but that wasn't the whole year, so I was wrong. Stocks did make a recent high of 29.30. But, in some ways that turned out to be a trap because it gave the impression that markets had broken out to the upside and that we were going to finish the year very strongly. And lo and behold, before you know it, the same concerns about rising yields. Because if you think about it, back in September, the concern was bond yields broke through 3% and we're going to go higher. This time, having muddled along and suddenly been 3.15 and more hawkish comments from the Federal Reserve and Mr. Trump criticising them for that and gone loco type remarks and things like that, which were a bit of a surprise to me, I must say, when I heard those. That we went straight back down, and now I guess we're in and around 27.50-ish, and we're back in the middle of that range. And if you look at valuations now, 1 year forward, the S&P 500 is on about 15 times. And earnings growth, and we're right in the middle of the earnings growth season, and this quarter is going to be 20%, but that everybody knows that, give or take. And some stocks have gone up on good numbers, like Procter & Gamble did on Friday. They had good numbers, the stock was up 8. And if you believe consensus forecasts that earnings growth next year will be 10, then 15 times for 10% earnings growth, with bond yields around here is fair. So, it feels about right that we've pulled back from those highs, that we're in the middle range. But of course, the market is so driven by the politics now. We're going to, remain volatile. And, who knows, to be honest, whether we will have some event that sends us to the bottom end of the trading range where we got to in February, March of 25.
Well, I think the FTSE is in the bottom of the trading range, isn't it?
Yes,
and Morgan Stanley recently said the FTSE, is cheap. Whatever way you look at the FTSE at the moment, it's cheap.
The FTSE is optically cheap. There are a lot of stocks with bond yields. I mean, we talk about US yields being at 3.2 and the S&P 500 yielding just over 2. I mean, UK yields are about 1.5 and equities probably yield 4. And you can build a collection of UK good quality companies that would give you a very decent income if you think of Shell and BP and Vodafone, which has been absolutely crushed.
Down at £1.50.
And Rio Tinto, BHP. But there's a portfolio of high quality, long term companies that will give you a very nice yield. Obviously, the difficulty in the UK at the moment is predicting what happens on Brexit and therefore what happens to the pound.
But we're 90 or 95% there, aren't we?
Well, maybe.
Okay,
we will see. I mean, that still looks a difficult deal, doesn't it?
Yeah. Well, I was in Brussels last week, and the commentary was not good.
No.
Okay, so let's talk about this, the trade sanctions. Okay, the Chinese market down in excess of 20% the last time I looked at it. This is a theme. Okay, I thought this would have been settled, and it seems clearly not the case.
No, and clearly you have two very determined politicians who do not want to give ground. And that has clearly exacerbated the situation for now. Now, who knows whether, President Trump can find a deal ahead, or if he wants to find a deal ahead of the midterms that,
Well, he's now talking about another tax cut ahead of the midterms for the middle income.
He's got to get that through. It's not straightforward. So, the situation in China is difficult. So, clearly the economy has slowed quite markedly. Property sales are struggling. Industrial capital expenditure has clearly gone into a soft patch. Consumer spending is a bit more patchy. You can look at different bits of data, but the gaming on Macau Island definitely slowed, but it looks like it might be picking up again. So there's lots of cross currents, but there's no doubt that the economy is slowed. And the data out on Friday confirmed that, but other research we see suggests that the Chinese economy is still in a soft patch. And of course, the government has come out with statements saying that they are going to support the economy. Make no mistake about that. And interestingly, to your point about the Chinese market is down 20% or whatever it is, the last 2 days it's up about 8%. So it rallied on the GDP, getting that out of the way sort of thing, and conciliatory comments, and it's up another 5%, or what last I looked, I don't know how it's finished, was up another 5% or so this morning. So a big rebound in that, both because the Chinese government is making commentary to say it will support the economy, and we've got this sort of GDP data out of the way now. And if you think back to, I think, 2015-16, a very similar set of circumstances. Chinese currency was weak, economy was in a soft patch. The government was starting to invest again in infrastructure, but it takes time to come into the data. And so stocks like Rio Tinto bottomed out in February of 16 and then doubled. Now, I'm not suggesting remotely that that's what's going to happen again, but it does feel in a similar way that the economy has slowed. We know that the government wanted the economy to slow and to have higher quality growth, drive to beautiful China, so less about the GDP number, more about the quality of growth and controlling pollution and things like that. So you are in this soft patch, which if we have sort of a repeat of what we saw at the end of 15, where everyone was worried about weak currency, capital outflows, weak property markets, I mean, all those things are at play again, and they sort of bottomed out in the first quarter of the next year. But it's interesting that the Chinese stock market, which has clearly been predicting these problems, as a forward indicator, the last couple of days, and it may be a sucker's rally, has bounced very strongly.
Okay, let's wrap up Q4, defence or offence?
Well, what is interesting, I think, from a market perspective is, growth has outperformed, in a low rate world, growth has outperformed very strongly for a very long time. And it's just interesting that, and it's, we are growth investors, so, in some ways it's quite a difficult moment, because you look at some great companies that you own and think, despite the fact that they might produce great numbers here, the stock is going to struggle because there's something of a rotation towards defence and value. The problem with the rally to value is a lot of that, the companies that are in value, are cyclical.
Right.
And people are simultaneously worrying about, is this the top of the cycle? Because the global economy has been expanding for a decade. So there's lots of cross currents on that, but no doubt at the moment, to my point about Procter & Gamble, good numbers, up 8%. It takes a lot to get a company the size of Procter & Gamble up 8% on results, but it just shows they produce good numbers, stock rallied strongly. Similarly, Philip Morris the day before, whereas some growth names had great results. So Netflix had great results, were up 11% the evening of the results, only finished up 5% the following day, and then were down the day after.
Right.
And have gone back from big rally to where they were, just indicating that at this moment in time, people are a bit concerned about multiples of growth companies that we've seen for a very long time, and they are looking elsewhere. So, as I say, Procter & Gamble, Philip Morris, things like that have rallied. The pharmaceutical sector, which has been out of favour for a long time because it's too defensive, concerns about biosimilars, concerns about President Trump's policies to lower drug prices, they've just started, they're beginning to look a bit better, performing a bit better. So, Roche had very good results on Wednesday. On the day they were down a bit, but have rallied since.
Right.
And that's sort of how it feels like the market wants to be. But, things are so difficult day to day, it only takes President Trump and the Chinese Premier to come out and say, we've found common ground, a solution, and having too much cash and being too defensive will temporarily, at least, probably look pretty difficult again. So, challenging markets.
Tim, on that note, thank you very much indeed.
Thanks very much.